Good. I think we'll get going. It's 11 o'clock and there's a fair bit to go through. So I get to start off doing the news, then Richard's got something to talk about. Then Andrew McHattie is going to be talking about what happened in January. And then Richard's going to be talking to Will Fulton from UK Commercial Property, which should be interesting, I think. Although at the moment we haven't got him on the system. I think hopefully he should come in soon and I'll let somebody else sort that out. So as I say, I'll just keep the news brief, really. So I'm going to talk about Aquila European Renewables, and then Richard's going to talk about Triple Point social housing. I did think about looking at the Castle Knoll bid for Dignity, but honestly, it's so complicated, it's so niche that I just figured it's just way too complicated for anybody to actually take in. So if you do want to ask a question about that, by all means, email us and we'll try and answer it. But it's several different types of share capital and loans and all sorts of stuff. So it's probably just not a good idea at the moment. Aquila, though, I just thought this has been a sort of disappointment for quite a long time. As you can see, the sort of went to move to trade at a discount, well, close to asset value into discount, and then sort of slipped quite badly recently. Discounts really widened out. I kind of feel, though, that things are going the wrong way, that actually it's sort of getting its act together. And maybe it deserves a bit of a re-rating. It's partly, I think, because it's been dragged down by the association with energy efficiency, which has been a real kind of disaster in the sector. And they're sitting there now on a 30% discount. And that's happened, A, because it's too small, and B, because it just took way too long to get invested, and it's still ploughing away and deploying its IPO process. So I think actually, no, that's not true. I think maybe this month it might have actually achieved it. So that's, I think, has affected the discount rating on this. But I don't think there's any other really good reason why it's happened, other than there's a few sort of stories around individual projects that they've got. In terms of size, then, it's a reasonable size, kind of midway in the sector there. The discount, as we say, is very attractive. The yield's fairly chunky, about 5.9. That is growing. We'll talk about that in a second. I won't get in charges out particularly outrageous. And its NAV actually looks pretty good. So since it started, it's been checking out some decent NAV returns. What it's just announced is its dividend target for 2023. So that's now 5.51 cents, which is 5% up on last year, and that was 5% up on the year before. And the impressive thing is the dividend cover. So that's going to be covered about 1.8 times, they reckon, by earnings. And they're saying that they can look forward for the next 5 years and be confident that they're going to have dividend cover of about 1.6 times. And that to me is the sort of market quality that things, I think this should be re-rated. They are going to try buying back some shares as a way of narrowing the discount. It's not particularly aggressive. So 20 million euros is about 7.8% of the market cap. It totally depends really on how much loose stock there is around. And that I'm not in a position to know really. So we'll wait and see whether that works or not. But if other buying comes in alongside it, then the discount could narrow quite quickly. To sort of encourage the narrowing the discount, the board and employees of the investment advisors have all said they're going to buy shares. There's some natural buying by the manager anyway, because they are getting paid with shares. So all of their fee, with some funds it's some of the fee, but in this case, all of the fee is being paid in shares that they then have to hold on to for a while. And they're going to carry on doing that all the way through to June at least. And they already own about 1.8% of the company. So it's all sort of good alignment with the other shareholders. The NAV is edging up, which is obviously good news. There's lots of moving parts in this. So inflation is obviously very helpful because of the way that the subsidies and everything else work. Power prices, interestingly, are going the other way in Europe, and the price cap had an effect as well. So the 180 euros a megawatt price cap. So that actually took off 0.5% from the NAV. But they are, and this is the sort of main story, that they are sort of pushing the portfolio towards being all sort of operational. So as things come on stream, that actually helps. Tesla is a plant they've got in Norway. It's nothing to do with batteries. They refinanced one of their Spanish projects. They signed a long-term power purchase agreement on one of the things that is still being built here. That's all good news. So that's pushing the portfolio up. And I think once this is finished, then we might get another uplift again. And they're not ignoring the fact that rates have gone up. So they have pushed up the discount rate from 6.9% to 7.2%, and that took about 3.5 cents. So the net of all of that was a sort of a smidgen rise in the NAV. But that, as I say, is encouraging, I think. This is where it's distributed. So mixture of wind and solar, mainly a little bit of hydro. I think that's in Portugal. And then sort of, really just spread around Europe. And as I say, so bringing assets online is going to help the NAV, I think. The power prices, this has really been linked to the fall in the gas price. So as European gas storage has filled up, gas prices in Europe have fallen quite dramatically. And obviously it's been a bit warmer than people are expecting too. So power prices are a lot lower than they were in Q4. I think there is room for those to recover again. We'll have to wait and see. But it doesn't really matter if they don't. Well, that's not completely but they're cushioned if they don't, because now they've got more than half of all their revenue contracted for at least 5 years. And the shift towards long-term power sale agreements, I think is really quite encouraging. So all of that, I think, just bodes well for the stock, really. So at this point, I'm going to hand over to Richard. And actually, probably I'll let you drive, Richard, if that's all right.
Okay, yeah. Let me just get the right screen on them. 1 second. Okay. Right, here we go. Thank you. Right. So yeah, interesting update from Triple Point Social Housing this morning. So a couple of, 4 quite big announcements within that. So they're going to cap their rental uplifts this year at 7%. Obviously, not obviously, but their leases are linked with inflation, so CPI and some of it on RPI, and obviously that's at 10.5%. So they're going to cap that at 7 this year to help out their tenants and things like that. I'll talk a bit more about that next. The rent collection is down. It was usually around 100%. For last year, it was 91.7. That's because 2 of their tenants are struggling and are in arrears. I'll talk about that as well. They're also proposing to bring in a new lease clause within their leases, which we've talked about before in regards to Civitas. There's little detail on what it is, but Civitas 1 is, and I'm guessing this will be similar, will be to help tenants who don't get or struggling to get sign off from the local authorities on housing benefit. If that happens, then they won't have to pay the rent until they do get sign off, and this rarely happens in this sector. So it's just to cover themselves and help the housing associations tenants achieve regulatory compliance. And they also talked about their discount, which is massive at the moment. It's 54%. And they're thinking of either doing a share buyback or a portfolio sale and return those proceeds to shareholders. So talk about the rental cap that they're going to do this year. So 7% is temporary, so it's just for this calendar year, and it's in line with the government cap on social housing that was announced at the end of last year. This specialist social housing that Civitas and Triple Point do is exempt from that, but they're going to bring this in line with that. Last year, its rental growth was 6.7%, helped by the inflation, like I said earlier. That was the largest in their history, and they reckon it's going to be around about that again this year. So this cap may have a bit of influence on that, but it would be similar. And I was just thinking perhaps it might be the first sign that their housing association tenants are struggling to achieve settlements with their housing benefit officers at the local authorities on the high rate of inflation. So far, when I've spoken to Civitas on this, they've said that they have been achieving the settlements on housing benefits at the rate of inflation, but perhaps this is the first sign that's stopped coming through, or there's sort of pushback on that. We'll see. So and then on the reg collection, so I said down massively on what it usually is. 2 tenants, so MySpace, there was a regulatory notice on them back in the last year, and then earlier this year there was an enforcement notice. So concerns around their solvency, it looks like they're going to go bust. It represents just under 8% of Triple Point's income. For Civitas, it's a lot lower, it's sort of 1.3 or something. So both are now looking to reassign the leases to other tenants. And so Triple Point did say in their announcement that if they did go into administration, the value of the MySpace let properties would fall 38%, which is 2.4% on the total portfolio. But that's if they don't reassign the lease before then. So, and then Parasol Homes, which is almost 10% of the income, haven't failed to pay rent for most of the second half of last year, citing operational issues, which Triple Point said they're working through, helping them out where they can, and expects to agree a payment plan going forward this year to help them out, and also to recoup the arrears from last year. We'll see what happens with that going forward, because that 10%, that's quite a lot of their income. And this is Triple Point's chart. As you can see, it's really come into problems in the last, well, the discounts widened massively in the last few months. So I think we had the sell-off at around sort of October time with the higher interest rates, and then I don't think they've been helped with all the goings on at Home REIT, and then we also had the MySpace announcement as well, which hit share price. So we see here how they're doing in the property residential sector. Like I said, 54% discount, which is wider than ground rents, which seems incredible. We'll see what's going on in ground rent sector. But like I said, I think what might be happening is a lot of the stuff going on at Home REIT has impacted the 2 social housing players as well. But it shouldn't really. They're completely different. The homeless sector isn't really regulated like the social housing sector is. So the quality of homes and things like that, you wouldn't have that issue in the social housing sector. And quick one on performance, you can see the NAV, pretty decent NAV performance, but the share price has been hit massively. So we'll see if this will all improve going forward. I think we'll get Andrew on now. Hi, Andrew.
Yeah, hi, Richard. Thank you very much indeed. Let me just swap over to my screen, and we'll talk about the movers for the month. And actually, I will touch on the social housing sector. So that was really interesting, Richard. Thank you. Good. It was a pretty decent start to the year, actually. And the sector index was up about 1.6% over the month. And I think this quite often happens at the beginning of January, when people are excited to see the new year recommendations that come out, and there tends to be a bit more buying than selling. Now, these figures do not include yesterday's rally, which was largely in UK-related stocks and in the real estate sector in particular, because of the more helpful remarks by the Bank of England about inflation and recession and interest rates. But anyway, it was still a pretty decent month overall, some quite good rises here. As has been the case, actually, it was the case last month, certainly, and fairly frequently. The Chinese trusts do stand out once again for substantial rises here from every trust in the sector, obviously on the reopening trade. And this looks quite sticky to me. It looks as though actually China really does want to start growing its economy again, and it'll be interesting to see how it plays out for these investment trusts. But we have covered that quite a bit over the month, so I'm going to talk instead about Blackstone loan financing, which is on the list there with a 14% rise. And the fallers were less dramatic, as befits the general positive tone of the market. A bit more of a mix here, and I'll talk about three of these. I tend to find there's better stories than amongst the fallers, particularly if you're looking for bargains and things that may have fallen out of favor and you can be a little bit contrarian. Anyway, it might just be that I love a bit of negativity, but there's three there that I'll focus on. So we'll start with Blackstone loan financing, which I did mention last month in our big roundup of the sector as being a rather complex trust, but one where the valuation really jumped out. So if you were prepared to do your own research, it might be interesting. And this month, the trust has announced a shareholder consultation on ways to narrow its persistent discount. And it's talking there about possible realization opportunities for shareholders, which might be one-off or they might be recurring, maybe more share buybacks, although it has tried those and they've been really quite unsuccessful. And intriguingly as well, it's also saying it could raise its dividend further. And it's already a very high yielding trust, but it does retain a little bit of its income. And it's saying there is scope there for it to put its dividend rate up if that would be helpful. So it's asking shareholders about this. And the price has rallied by 14%. But in a way, I feel it could have done quite a lot more and potentially will do quite a lot more because the yield is still extremely high at 10.7%. And the discount's still 18.5%, as you can see from the chart. So my sense is that it was a little bit of a lethargic reaction. It could have been a bit more dramatic. Clearly, it could be that the trust consults with shareholders and says, well, actually, you told us you're quite happy and we're not going to do anything. So there is that risk. But this isn't an isolated incident. There have been a couple of others as well that I think are quite interesting and maybe indicates that either investors are just not being very reactive at the moment to the news flow, or they don't believe it, or they can't be bothered. I don't know what it is, but US Solar Fund, I think, is another one where, again, in response to a persistent discount, the board announced a strategic review. That was back in October. And they indicated there that the options available to them would include a sale of the entire share capital. And I think reading between the lines, the likelihood was that was pretty likely. And I think actually from some news a couple of weeks ago, it's become more likely because they announced the sale of their 50% share in one of their big projects for $52 million, which means they've got the cash now. That was about 17% of their NAV. And I think probably a winding up here looks the most likely outcome, although I have absolutely no knowledge of that. But again, here we can see the discount hasn't really narrowed very much, and it's still quite substantial, still 13.6%. And I feel that perhaps there's an opportunity here for investors who are keeping abreast of the news flow and maybe feeling that the reaction here has been a bit sluggish in the market. And the third one, the final one of the trio here, is VPC specialty lending. this was attacked really by some dissident shareholders who felt that some action was needed. And in December, the trust said it is proposing a managed wind down, which needs ratification, but I think that will go through. It might take a couple of years, actually, because their assets are not very liquid. And they do have some shareholdings in quite illiquid stocks in the US, which might be difficult to dispose of. So in addition to their loans. So I can see why there's a reason for a bit of a discount remaining here, but it's still 17%, which when a winding up is on its way, again, seems quite wide to me. And my sense is that if you're a patient investor and you take a stake in these trusts, you'll probably get quite a nice payoff over time. So it's not without risk, it never is, but nevertheless, I think it's quite interesting to look at those. Moving on now to the trusts that fell last month. One of those was Augmentum FinTech, which surprised me a little bit because we have seen a bit of a bounce in some of the tech. So Polar Capital Tech was up this month, and also Chrysalis has actually been recommended by several brokers now, and I think that there are there's the first little green shoots maybe appearing, but this trust went in the opposite direction. And you can see, I mean, a very unhelpful chart here showing the NAV basically totally flat for the last, or nearly the whole of the last year, while the share price comes down. The problem here is that the trust only announces its NAV twice a year. And actually last time it barely moved, which is why it looks flat. And maybe we could do with a little bit more information about how the NAV is evolving, because I feel that maybe one reason why investors are reticent here is because they just don't really have enough information and they're a little bit in the dark. The news that has come out from the trust has been quite good, actually. I mean, they've just made a new investment into a reinsurance operation in Germany, committed to a new funding round for Zopa, the digital bank. Though they didn't say at what price. Again, it's not, they're not being that helpful and transparent to really encourage you to make an investment here. So you've got this massive discount, 37%. And I think it does look quite enticing, actually, but it's a leap of faith because I think there's just a bit of a lack of information here to really back a strong position. So quite interesting. I'll be following that one to see how it plays out. Civitas, Richard's covered it really, but I was just going to mention that it did have a good bounce yesterday. And my sense was that it probably was oversold in relation to the MySpace news, which was only 1.3% of its rent roll. I think that was just, it's really a case of being kicked while it's down, and that was just a fresh kicking it was getting. But the trust actually put out quite a strong trading statement last month, really defending what it called its robust financial position. And you've got to feel there's an opportunity here with such a big discount. In this case, it's about 48%, just a little narrower than triple point. And again, the yield here is 9%. I've talked to Civitas quite a lot over a period of several years now. And my feeling is that they do have a very good understanding of what the regulator is looking for. They work closely with the regulator. And so I don't think they're really being surprised by anything that is happening now. Again, it's a bit of a risk, I suppose, but perhaps they will come through this and that discount will narrow. That was really interesting what Richard said about Triple Point possibly being prepared to sell some assets and repatriate some capital. So maybe that will be a trigger. And the last one I'll talk about is RIT Capital Partners, a bit more mainstream. This is on a very wide discount of 20%, which is quite unusual for this trust. It tends to be much more highly rated. And here the price has been depressed by, well, one article in particular that appeared in the Telegraph it was written by Richard Evans. He's a very seasoned investment trust journalist. And he was making the point here that their assets are actually much riskier than I think many people would expect from this trust, which is intended to be diversified, a bit of an asset protector in tough times. And I think this has been picked up by some other commentators, and the price has been a bit depressed. The main issue that Richard Evans, not Richard Williams, was making is that a much bigger chunk of the assets is in the private venture capital assets than many people realize. And because of the lag in valuations, you can expect those to fall, which was making actually RIT looking a lot more risky than was widely acknowledged in the market. So we can see actually from the last report on the screen here that the private investments were 43% of assets, and that has grown actually quite a lot over recent years. So there are different opinions on this now. Numis say it's an unwarranted sell-off and that the shares are cheap, but we'll have to wait and see, I think, what happens to the valuation of those private assets. You can see that the discount has really widened out pretty substantially here. So we'll see what happens there. The next results are due at the start of March. So I think they're going to be well worth focusing on. All right, there we go. I think there's just one question that I can see here. Do you like playing the wind-up stories in your own portfolio? What's been your experience? Do they tend to work out, or do things get extended and dilute your return? Yes, I mean, I own one of those three at the moment, and I'm looking at the others. But I think there's one slightly analogous situation actually was with, for example, Dunedin Enterprise, which I did own for a long period actually. And the wind up there was extremely profitable if you were patient. So my experience has been good with these. And I suppose, the risk is that they're a little bit dull in the short term, that you put them in your portfolio and they do absolutely nothing for a while. But I think the downside is somewhat protected. And I think they're interesting and worth looking at.